Bill Baruch is president of Blue Line Futures. Bill, always good to have you with us. And I did want to start right there. I mean, we've really seen that the range that the S&P 500 has been in is pretty clear now. When you look at it, what are you seeing and what are you watching for by way of a catalyst one way or another?
You're right. It's tightening range here. And, one of the things that we are looking at is the support. 4186 has been a very big level for us on a technical basis on the way up, and really it's sort of a area of tether. The market's tethered to that area as it consolidates lower at times like today. The fact that it's closing above here now or set to, it's very supportive, we think, and it basically was a rejection early on the opening bell below there, and I think that's supportive. But again, we haven't broken out of that range. So we're looking at the jobs tomorrow. One of the things that did pressure markets early today was the fact that weekly jobless claims got below 400,000 for the first time since the start of the pandemic. You also had ADP payrolls, nearly 1 million. But ADP payrolls had a big number last month, and then the non-farm official number was a far cry from that. So can't really take that with a grain of salt. Looking at tomorrow's non-farm payroll, that's what we've been saying. The week culminates into this number, and you're already seeing some Fed speak talk about, they're saying, let's talking about a timeline for tapering. And if we have a big report tomorrow, they're going to be talking about a timeline for tapering. So that's what's going to get the dollar going and get rates higher. And talking about rates, you were talking about the tech names, and big tech is in a lot of the tech sector in general is not going to perform if rates keep going higher. And we're referring to this as a long-term thematic divergence. And you got to be very selective in the tech that you own.
And so let's just drill down into that a little bit here, because, of course, the betting on higher rates has been wrong, or at least premature, I guess. Maybe not wrong, but we got a little ahead of it earlier in the year. How solid did the jobs data need to be, in your view, and how, I guess, confirmed by the Fed does the move on rates or tapering need to be before you see a really strong market reaction?
Well, I'd say a lot of people got ahead of the narrative, or the narrative got ahead of them maybe earlier this year. Not for us. We were calling for higher rates back in October of last year when the 10-year was at 60 basis points. We put a target out as a minimum of 1.25%. Again, this is going back to October of last year, and we said if it gets above 1.25%, you're going to see a melt up. The velocity is going to move, and that's going to be a high velocity move up to 1.5 to 1.7, and that's exactly what happened. So just to take it back with that real quick, where the velocity is what matters when the treasuries are moving. And so even if we move up to 2%, really, if it's a slow move through the summer, I don't think that's a big deal. But I don't think that's really where we're heading right now. I think we're really very, very consolidated. The range of the 10-year has been very, very consolidated. It's at 1.6%. You're good. You're going to have a really big reason to have the Fed start moving their narrative ahead in the timeline to taper. I on the other hand, really, at this point, I think the move in rates has happened. I think it's really on the Fed, and the Fed is patient. They're telling us that they're going to be behind the curve. They're telling us that they want to see the data. And last year, they changed their policy to allow for symmetric inflation targeting. So, I mean, they're going to take this as slow as possible. You're starting to see some Fed members, Harker yesterday, Kaplan today, but I think that the Fed wants to see hard evidence, and the longer that we talk about tapering, the more the market's going to bake in the tapering. I think the taper, really the plan that the Fed at some point is going to tighten policy, that was priced in, on that move in February and March and the rates. Now it's moving past that. You're going to have knee-jerk reactions where the 10-years could spike a little bit, 1.7, 1.75, 1.8. When they talk about taper. But I think for the most part, a lot of this is priced in unless there's a dynamic shift where we start seeing a tremendous amount of job growth and then inflation that's also hot month after month after month. And I just don't see that being the case right here, right now.
Where does that leave you with gold, which has, we have seen it moving a little bit similarly with the yield off those inflation fears and expectations. But what else is driving gold? What are you watching?
Yeah, I mean, gold's down pretty big here today, almost 2%. A lot of the metals got smoked. I mean, really, the dollar moved up pretty steadily today, and then that's on the jobs data, but it was also starting to move ahead of that. And we were thinking that the dollar isn't going to really make a big move ahead of non-farm payroll. We've seen it before where it starts to make a big move ahead of non-farm payroll. It's almost like it's giving, creating some pain to the greatest number of people. Maybe that's what we're seeing here today. But gold for us, it's in a breakout while holding out above 1850. And there's several narratives that are going. I mean, I think a lot of that the weakness that we saw in gold through March has priced in the fact that at some point the Fed is going to taper their policy. But as long as the rates don't really start moving quickly through 175, 18, then gold can consolidate and gain ground as long as the dollar is not also moving higher like it did today. So we like gold. But a lot of the narrative in general, we think that silver and platinum will outpace gold from these levels, and so that's something to kind of take into consideration when you're planning out. But 1850, there's a lot of support there. 1915, there was a lot of resistance. So gold is just consolidating within that 1850 to 1915 range so far, and maybe we get a reason to break outside of that with tomorrow's non-farm payroll number.
The dollar strengthening will take a little bit of pressure off Chinese authorities, perhaps, but we've been watching that Chinese yuan move higher, and with the trade talks coming up between China and the U.S., renewed attention on how the government might manage it. What are you seeing here?
Yeah, the Chinese yuan broke when it was against the CNH USD. This Chinese yuan strengthened and broke out of a decade-long downtrend. And that's what it's coming back in this week. The dollar has strengthened against the Chinese yuan this week, and so you're seeing the Chinese yuan come back in. That's one of the things holding back the metals a bit here. Right now, you're seeing, again, gold being down sharply, platinum's down 3%, silver's getting tagged 2 to 3%. And the weakness in Chinese yuan, I think, has a lot to do with that. Copper's down really big. Copper's down 3% or 2.5%. So, the Chinese yuan broke out, and that, I think it's still in a breakout overall until we close back below that trend line, or vice versa, back above that trend line. However you're looking at it, and again, if you're looking at the dollar in general, the dollar index is, it's rallied pretty good today. That's a basket of currencies, 57% the euro. So, it's really matters what's the dollar could be doing something, but what is it being paired against? Do we have a reason to be breaking outside of some of the current ranges given tomorrow's non-farm payroll report? So I think a lot's going to really depend on what we see tomorrow. And I don't think it's going to give us too much of reason. Like I said, I think we see 500 to 700,000 jobs somewhere within that pocket. If we're outside of that, then you can get a move in the dollar.
All right, we don't have a ton of time here, Bill, but I want to ask you, of kind of the fundamental drivers. The improved economic picture in the U.S. is one that I think there's some agreement on. Things look good. They're going to look good. Is there risk in that as government support is withdrawn and some of the lasting effects of the recession emerge? I think about that in Canada, too. But for the U.S. market, is there a risk that the economy is not as healthy as it appears?
Yeah, I mean, there's definitely been a good rebound for the last couple of months, and I think there's definitely concern for that. I think there's a lot of people that are the hardest hit demographic is still is struggling right now, and there's jobs that were lost that are never going to come back, and the economy is going through a transformation. A lot more e-commerce, but there is still a lot of pent-up demand that you're seeing. I think that you're going to see through air travel this summer, vacation travel this summer. So I think the economy is going to be a little distorted. I mean, and there's going to be lumpiness throughout different sectors, different spaces. So I think that's a major reason why the Fed's going to be very patient in removing their support, because it's just you're not sure. You're not sure what's, how the picture is when the tide goes in a little bit, where they're pulling back that support. So, yeah, I am concerned. And if rates really, again, if the Fed moves too quickly, or if the narrative surrounding the Fed is getting too hawkish too quickly, then that's what gets the Treasury market going. The rates will rise in a high velocity manner, like we saw late February and early March, and that's where the market could get hurt, and the stock market would sell off and risk assets would sell off. But I think if the Fed continues to softly coach their narrative ahead, you get a grind higher in rates, that is, I think, overall capped, and the market can find that accommodative in general.